Future gold market analysis. Shaping factors and outlook. The gold market, with its millennia-long history as a store of value and medium of exchange, continues to be one of the most closely watched investment channels globally. In the context of a highly volatile macroeconomic environment, shifts in monetary policy, geopolitical tensions, and technological advancements can all have profound impacts on gold prices. This analysis will delve into the key factors shaping the future gold market, offering potential scenarios and outlooks. Overview of the current gold market. As of mid-2025, gold prices have experienced significant growth in recent years, particularly after the COVID-19 pandemic and amidst rising inflation and global uncertainties. As of mid-2025, gold maintains its appeal as a safe haven asset, especially as major economies face challenges such as persistent inflation, localized recession risks, and record-high public debt levels. Current factors supporting gold prices. Persistent inflation. Although many central banks have implemented tightening monetary policies, inflation remains above target in numerous countries, making gold an effective hedge against inflation. Geopolitical instability. Regional conflicts, trade tensions, and divisions in the world order continue to drive safe haven demand for gold. Divergent monetary policies. Differences in the interest rate paths of major central banks create uncertainty, encouraging investors to turn to gold. Central bank demand. Many central banks worldwide, especially in emerging economies, have been increasing their gold reserves to diversify assets and reduce reliance on the US dollar. High public debt levels. The escalating global public debt levels concern investors about long-term financial stability, thereby pushing gold prices higher. Current factors hindering gold prices. Positive real interest rates. When nominal interest rates rise higher than the inflation rate, the opportunity cost of holding gold, a non-yielding asset, also increases, reducing its attractiveness. U.S. dollar strength. Gold typically has an inverse relationship with the U.S. dollar. When the USD strengthens, gold becomes more expensive for investors holding other currencies. Stock market recovery. If global stock markets experience a strong and sustained recovery, some capital flows might shift from gold to riskier assets in pursuit of higher returns. Macroeconomic factors. Shaping future gold prices understanding. Macroeconomic factors is key to forecasting gold price trends. We will examine each factor in detail. Monetary policy of major central banks. Monetary policy, especially from the U.S. Federal Reserve, Fed, the European Central Bank, ECB, and the Bank of Japan, BOJ, has a profound impact on gold prices. Interest rates. Impact. Rising interest rates increase the opportunity cost of holding gold, as gold does not pay interest. Conversely, low or falling interest rates make gold more attractive. Outlook. As of mid-2025, the Fed and other major central banks may be in a pause phase or beginning to ease monetary policy if inflation is controlled or economies slow down. However, the pace and extent of easing will be a key factor. If rate cuts are slower than expected or not strong enough to boost economic growth, gold prices could be constrained. Conversely, if central banks are forced to cut rates aggressively due to an economic recession or financial crisis, gold will receive significant support. Quantitative easing, QE, quantitative tightening, QT. Impact, quantitative easing, QE, increases the money supply, often leading to inflation and currency weakening, supporting gold prices. Quantitative tightening, QT, has the opposite effect. Outlook. Currently, many central banks are still in the process of quantitative tightening or reducing their balance sheets. This process may be prolonged, but if central banks are forced to return to QE in the future due to a severe recession, this would provide a significant boost to gold prices. Inflation and inflation. Expectations. Inflation is one of the primary drivers of gold prices. Gold is considered a hedge against inflation because its real value is often preserved or increases when the purchasing power of currency declines. Impact. When inflation rises and is expected to remain high, investors seek gold to protect the purchasing power of their assets. Conversely, low or sharply falling inflation can reduce safe haven demand for gold. Outlook. Despite signs of cooling, inflation remains a persistent concern. Factors such as volatile energy costs, supply chain disruptions, and wage pressures could still push inflation higher than central bank targets. If inflation expectations remain anchored at high levels or even increase again, gold will continue to receive strong support. Global economic growth and recession. Risk. The health of the global economy significantly influences investor sentiment and capital flows into various asset classes. Impact. During periods of strong economic growth, investors tend to seek higher returns from riskier assets like equities, reducing gold's appeal. Conversely, when there's a risk of an economic recession, gold becomes a preferred safe haven asset. Outlook. Major economies face varying degrees of recession risk. Europe may struggle with slow growth. China faces challenges in the real estate and consumption sectors, while the U.S. might experience a soft landing or a mild recession. If the risk of a global recession becomes clearer, capital will flow strongly into gold. Conversely, a strong and sustained economic recovery would limit gold's upside. U.S. dollar strength. DXY gold is priced in U.S. dollars. Therefore, the strength of the greenback has an inverse relationship with gold prices. Impact. When the U.S. dollar strengthens, gold becomes more expensive for investors holding other currencies, reducing demand. Conversely, a weaker U.S. dollar increases gold's purchasing power. Outlook. The strength of the U.S. dollar depends on interest rate differentials between the U.S. and other countries, relative economic conditions, and the USD's role as a global safe haven asset. If the Fed continues to maintain higher interest rates than other central banks, the USD may retain its strength. However, if the Fed begins to ease policy more aggressively, or if confidence in the USD is eroded by public debt or other factors, gold will have an advantage. Public debt levels and financial instability. Global public debt has risen to unprecedented levels, especially in developed economies. This raises concerns about repayment capacity and the stability of the global financial system. Impact. When investors worry about sovereign defaults or financial crises, gold becomes a safe option to preserve wealth. Outlook. Public debt pressures are expected to continue increasing in the future. Countries will face pressure to pay higher interest rates. If financial tensions escalate, or if there are signs of a debt crisis, demand for gold will surge. 3. Geopolitical factors and global risks. Geopolitical events are among the most unpredictable, yet highly impactful drivers of gold prices. Regional and global conflicts. Impact: military conflicts, e.g., Russia-Ukraine, Israel-Hamas, tensions in the South China Sea, or other hotspots increase instability and drive safe haven demand. For gold. Outlook. The global geopolitical situation remains highly complex and unpredictable. Any escalation of current conflicts or the emergence of new hotspots would create strong upward pressure on gold prices. Trade tensions and tech wars. Impact: trade tensions between economic superpowers, especially the US and China as well. As the race for technological dominance, semiconductor chips, AI, can disrupt supply chains and create uncertainty, encouraging investors to seek gold. Outlook. De-risking and decoupling policies in global supply chains may continue. If trade and technological tensions escalate, weakening global economic growth, gold will benefit. Internal political instability. Impact: political instability, important elections, or sudden policy changes in major countries can create uncertainty and increase demand for gold. Outlook. Upcoming key elections in many countries, coupled with increasing political polarization, could lead to unexpected fluctuations in financial markets, including gold, AFI. Gold supply and demand. Underlying dynamics, in addition to macroeconomic and geopolitical factors, supply-demand balance also plays a crucial role in shaping gold prices. Gold supply mine production. Current status. Global gold mine production has been stable or slightly increasing in recent years, but finding new high-quality gold deposits is becoming increasingly difficult and expensive. Outlook. Mine production may face challenges from high energy costs, stricter environmental regulations, and declining ore quality. This could limit new supply in the future. Recycled gold. Current status. The amount of recycled gold often increases when gold prices are high, as it encourages people to sell jewelry or old gold. Outlook. Recycled gold will continue to be an important source of supply, especially during periods of strong gold price increases or economic crises that force people to sell assets. Gold demand, jewelry demand. Current status. Jewelry demand, especially from Asian markets like India and China, accounts for a large portion of total gold demand. This demand is sensitive to gold prices and economic growth. Outlook. Economic growth in emerging markets will boost jewelry demand. However, excessively high gold prices could reduce this demand. Investment demand. Bars, coins, ETFs. Current status. This is the most volatile factor and often reacts strongly to macroeconomic and geopolitical factors. Outlook. If the macroeconomic environment remains uncertain, inflation persists and real,